Hello, hello, hello. What is going on, everybody? Thank you tuning in to Crypto Street Podcast. This is Dale coming to you live, kind of, sort of. It's July 30th. We are got a cool guest tonight. It's Prince and I balling out, slapping some puck around. I'm gonna make Prince look like he's a damn pee-wee goalie. Because I'm gonna triple deke his ass all day long. What's up, buddy?
Hey man, yeah. Considering I haven't actually put on any gear in 5 years or so, yeah, I'd
Wait.
probably.
I'm gonna stop you right there because you act like I can even ice skate.
Well, I'm just gonna say I'd probably take myself out from injury, just just being so out of shape. But
Oh, funny. What's good with you, buddy, old pal?
nothing much. I've just been playing around with that FTX platform.
Yeah,
The new futures, and it's pretty cool, honestly. They're doing what I like, and they're offering a lot of stuff that I want. So yeah, I've just been tinkering around with that and made a lot of money on that FTT token launch.
you did.
So it's been good though. Yeah, it's been.
So that's good. I've got a little stenchy house right now. And maybe you know this and I don't, but I know I'm gonna get my balls ripped apart for this, but I don't even care. So I made BLTs tonight for supper. My wife was working late, so I thought, you know what? I'm gonna take some initiative. I'm gonna have supper ready when she gets home. And I totally didn't know. Okay, so I was cooking the bacon, and it was splattering all over the place, So I'm like, okay, I'm gonna just put a lid on this skillet type thing. Bad idea. Have you ever done that?
Oh yeah.
It literally, I walk into the living room to get something for my kid, and then I walk back, and it's like smoking on the inside, and I open the lid, and I'm not kidding you, the bacon is straight up black, and it's like an inch or two big. So I was just like, all right,
well,
I got it.
Cooking with Dale. There we go.
Yeah, cooking with Dale. Show you how not to cook stuff.
Yeah.
All right. So you're good, I'm good. Let's cut into
let's get into
rock
it.
and roll. Do you want to give the intro?
Sure.
Let's do it.
Yeah, we got a good guest tonight. It's somebody that we had met. It was last August. Met in Philly at a conference. I think it was the first kind of conference we ever went to.
Ate lunch with him.
Yeah, I ended up having lunch with him. Great guy. And then we actually linked back up again at Consensus recently. We just ran into each other, and so small world, right? So I've been in touch with him a bit. Alex Davidoff. Alex, thanks for coming on, man. Thanks for giving us some time. I know you're a busy guy, but yeah.
Yeah, absolutely. Thanks a lot for having me on, guys. It's good. I know we're going to talk crypto options stuff tonight. It's kind of a very, very niche area.
Yeah.
I'm looking forward to it because this is the one of the areas right now I'm noticing on, at least in this little social media community, we'll call it crypto Twitter, options has been kind of the hot topic as of late. A lot of people are getting into options, and in particular, a lot of people are getting into equity options, all of that stuff. But in general, not a lot of people have any experience with them, I'm noticing. And Alex, this is your area. You're an options guy. So, but before we get into all the options stuff, let's just start out with your background, when you got into the markets, when you realized you fell in love with them and you wanted to be a part of it, with your future, your career. Let's just get into that whole shebang.
Okay, I'll try to make this brief. So I met you guys in Philadelphia. I'm from the Philadelphia area. Did a couple internships on the Philadelphia Stock Exchange, working on the equity options floor when I was in college. And I'm like, okay, this is, pretty cool. I really like the aspects of options. I got a job working as a trading assistant on the NYMEX commodity options trading floor out of school. Eventually started trading my own books, part of the trading firm. Went out on my own, got financially backed by somebody. I've been on the floors, the trading floors for many years, I guess, trading in the open outcry pits from 2008 to say 2015. And actually, it's funny when you see trading places, I'm one of the only guys that's actually ever traded in the FCO, in the OJ options pit. Most people, I actually have traded in that pit, as small as it was. It's kind of funny. People tell me to mention that more, so I'm mentioning that.
That's cool. Like I'm young guy, and like I'll probably, I'm past the pit days. So I find anybody with stories about the pit kind of fascinating because I'll never really get to experience that. But that's what was being in the pit like for you?
It's like a totally different world. Like, everybody is really about as abrasive as you could possibly imagine. And, I mentioned the FCOIJ thing because I don't know if you guys remember the movie Trading Places, Eddie Murphy and Dan Aykroyd. So it's like a lot of people are so young that they don't even remember that. And it's like it's a surreal experience, but also too, you really, as much as you like the guy and you like a lot of people there, you hate a lot of them too. And it's a really, like, nobody works for the same group, and there's a real lot of acrimony there. So, I have a lot of good relationships with people from the floor, but there are a lot of people I would see some of these people and I do not like them. So,
get a little street fights going.
No, that's heavily discouraged. The fines and the suspensions are both heavy.
Oh, okay.
That never happened.
Wow.
At least,
okay.
But that's another story for another time.
So what would you do to like get a jab in on one of them?
It's a lot of shit talk. A lot.
Okay.
And
so it's like a game of sports pretty much. You're on the field or something and you're just shit talking each other all the time.
It's a good analogy, but
that's a good point. That's a good analogy.
It's even more abrasive than that, where any sort of slur, racial or ethnic, I've had my fair share thrown at me.
Yeah.
I can't say I haven't thrown them back because I have. But that's just the environment that it's in. That it is. And I don't know, it started to die at the end of 2015, and so I left it behind, went off floor. And the good thing about the transition to electronic markets, I mean, the bad thing is that as a floor market maker, you lose a lot of your edge because the spreads widen out and your ability to see the order flow is gone. But that's just the nature of the business. That's just the way the business has transitioned. But I was introduced to crypto in late 2016. It's much better to be lucky than good in trading. So, I started, doing some small trades, evaluating. Obviously, from the long side, it was very good. And then, once you see something go up, say 300, 400%, and then keep going, it's time to start taking, okay, there's got to be something here.
Yeah.
And once I mean, obviously, everybody who's listening to this is, I think, has a bullish perspective, from a long-term perspective, that they're very bullish on the technology. And once you go down the rabbit hole, there's no really going back. And I've made a fairly significant transition. By the end of 2017, I was doing consulting and advising for, some projects, some institutions, high net worth individuals. I'm still looking for, crypto work and, a bigger blockchain project. Ideally, it would be great if I could use my options experience. So if anybody's listening to this and they're interested in somebody with my background, please reach out to me. I'm always looking for consulting advising work. And definitely if there's like a full-time project, like a good one that I want, and you guys have a good idea, good project, I want to be a part of it.
Well, it's an interesting space right now in, like a little subspace of crypto because, we're seeing derivatives, they're just blowing up. And we've seen, actually, there's been some people come out and say, like, they think the derivative space for crypto is going to completely just morph into something insane. And it is already, like, we're seeing it happen. BitMEX has taken off so much. But options is the side that really it's not where it's needs to be, and it's still very low key. So, but we're seeing more people getting into it. So that's, to me, the options side of the derivatives game for crypto is fascinating, just to see it evolve. For the listener who maybe has never traded options, doesn't really know much about how they work, but has an idea what they are. They've heard the term options, and they're kind of curious about them. What would you say, kind of a rundown on them for this individual?
Aside from don't trade options, I try not to shy people away from it because, they, at working for a trading firm, they really ingrained a ton of stuff into us on options. It was a year or more, in training, learning about how to make markets and trade volatility and stuff. And that's something that you just can't translate over into somebody immediately. So if you're
Right.
going to do it, and obviously I think that you should, if you're interested in it, you just have to make sure your risk management is very disciplined. You define your risk reward targets appropriately. Start small, make sure you start. I think it's always good to have a small amount of money on the line, even if it's just like, say, even if you're playing around with just say 0.1 BTC or whatever, and you're just messing around on the exchanges, if it's not going to hurt you that much, that's fine. But that's the beauty of crypto markets, is you can trade such small fractions of the options, especially in the retail ones, and that's a great way for people to learn with money on the line. So yeah, it makes sure you're, don't be afraid to sell options, but also too, make sure your risk and rewards targets are, coming in there. Last thing I want to mention is Theta is the time value, the decay of options. The Theta bill comes due every day, sometimes every minute, sometimes every second. So trade accordingly. We'll get into Theta a little later.
Yeah, Theta, because I know when I first started trading options, and it wasn't extremely long ago, probably in the last year, I've gotten really into them. And it's a wake-up call, because you can't, like, I realized pretty quickly, it's like I can't trade these like I would be trading futures, say, and especially on Deribit. A lot about it, you just can't, like, you can't get in and out. You got big spreads to worry about. So yeah, it's a whole different game. And so I like that, though. Don't trade options.
Yeah, well, if you're going to trade them, start very, very small, and don't. Last other piece: don't sell teenies. Do not sell teenies. That's one thing you should never do.
And when you say that, what do you mean now?
Like a small way out of the money, like say a BTC 50,000 call.
Right.
Do not just naked sell that option thinking you're going to pick up the premium.
Especially with Bitcoin, Lord knows.
Especially with Bitcoin.
Yeah, it's terrifying selling calls or anything like that on Bitcoin. It's like, I know I had dabbled in it a little bit, and I'd actually I was like, yeah, I kind of tried. I'm doing my first little call selling, but I'm keeping it small. And I think I was out of those within like 24 hours. I was like, I remember I texted you about it. I was like, fuck this. Like, I'm not playing this game.
Selling calls is very dangerous. But even too, like say right now the expiration, the Friday, August 2nd expiration in Deribit, the 8,000 put is trading for $4.84. $4 at $9. Don't sell that either.
Yeah,
the risk reward on that is it's incredibly not worth it.
Yeah. So, okay, now we're kind of getting into Deribit here. I'm curious what your opinion on Deribit as a platform is, because you come from the legacy market, so you got a lot of experience with how these operations should work to be able to handle large volume, all of that stuff. Deribit's leading the space right now when it comes to options activity, but I'm curious what your take is on them as a platform.
So, full disclosure, I have spoken to Deribit COO Marius Jansen about becoming an active market maker on the platform in the past. I decided not to do it because obviously, it's off limits for US investors, and you have to go through the process of creating an overseas corp to do all that stuff. So I'll be honest with you, with any sort of size, I don't want to necessarily trade behind a VPN and, try to sidestep their regulations. So I really don't even trade them at all.
Yeah.
I know people who do trade them, obviously you guys. It's, clearly a really interesting platform, and I've definitely explored it. It's just, I think it's only really geared right now towards the retail investor. I know now, did you guys want to talk about how the Deribit crypto options platform relates to traditional markets and the initial market structure of that?
Yeah, I think let's cover that, and also just your opinion in general, right, on the platform itself, and activity on it. What your thoughts are as an options platform?
It's good it's the best thing out there right now for options,
right?
For crypto options. I haven't. LedgerX is an institutional size platform, but they require 100% margin apparently on all their trades, and the volume is fairly thin. Yeah. Now, also too, I mean, there is some volume there, but that's a bit of a problem. So when you're talking about options on different platforms, so say a guy does a big trade on LedgerX, and he gets a great value on it. Yeah, the problem is he has to post a ton of collateral, but if he gets a good enough value on Ledger X, he might lay a lot of the risk off on Deribit and arb people on the platform.
Right.
So that's the other thing you have to remember is if you see a lot of big volume trading there, maybe somebody's laying that off on Ledger X, or maybe somebody from Ledger X is laying off their Deribit action.
Right.
So that's one of the big games we used to play in the traditional markets was just arbing, the electronic against the floor against the OTC platforms. So that's another thing you want to watch out for. I mean, kind of going into the traditional exchanges, that's the other kind of problem with Deribit. So Deribit, in the same way that BitMEX does this, is an exchange and clearer in one.
Right.
So in traditional markets, you guys, you don't connect directly to the exchange. You have a broker that connects to the exchange for you, whether it's, you guys might, identify this with, say, Interactive Brokers or TD Ameritrade or whatever else you use to trade equities and equity options. It's different for futures and futures options, the commodity products that I'm used to trading, where you have a different clearing entity, but it's essentially the same function. I've been kind of critical of this model in the past, especially as it pertains to BitMEX. I don't know very much about the platform. I don't think that they are totally above ground. I don't know if you guys have had any BitMEX people on at all to talk about it. I hope you're not getting paid by them because
Negative.
I mean, I'm not getting paid by Deribit, but if you're asking me which one I would rather use, I think that Deribit is a more trustworthy platform. I think that John and Marius in particular, they want to build. These guys are, John is a former trader and Marius is a crypto guy, and they want to build out a crypto options platform. I just don't know if they have necessarily the capability to do that. I don't know what the capital they have backstopping this. I did hear that and this kind of makes me happy that I didn't necessarily become a maker on the platform. I heard a lot of the makers blew out, and one of the, and then some of those kind of conglomerated. I'm not going to name names on.
Well, yeah, there was that like 25% move, like in a span of an hour or something back a few months ago, right? When it kind of pumped off the lows, and like that's a devastating move, especially
the important thing to remember is that options is a zero-sum game, so somebody made money on that.
Yeah.
For every guy that blew out, somebody else made a killing. And the good thing about Deribit is that it served its purpose, but from what I understand is that the exchange itself took over those positions and sold them off. And that in traditional markets, like hearing that happen is almost an anathema, where that would correspond to, say, an entire clearinghouse failing. And that does happen where clearinghouses have failed, but then usually that gets to the point where the exchange doesn't even get involved and the clearinghouse auctions off the positions or whatever.
Right.
And when you combine those two functions together, and then you also bring in the whole sphere of a crypto exchange and how a crypto exchange can easily get hacked when you're talking about hot wallets, cold wallets. I don't know what their risk management procedures are like. I don't know how their tech works. I do have a very great relationship with Actin. Actin is the exclusive off-the-shelf tech provider. I spoke to the CEO of Actin, Dan Sachs, also a friend of mine. So if there's any market makers who are listening to this and you're interested in making markets on the platform, especially if you're, an old school, retail guy, or not necessarily a retail guy, if you're one of the, I guess, a local or a proprietary trader who's interested in making markets, please reach out to me. I can help you get set up on this stuff and you can get going. I've looked at all the procedures necessary to do this. It's doable and it can be done. It's just not something that I decided to do.
Yeah. Okay.
So I don't know if there's anything else you want to cover on the platform here.
So if you, for Deribit, let's say for Deribit to maybe go to that next level, or anything, options in general in crypto to get to that next level, what do you want to see then?
I think I've spoken to the CME about this as well. I think right now the easiest thing that could happen is for the CME to list options. I think that would be the easiest and the best thing, because then I think you get a lot of the institutional players in there. If an institution is going to use Deribit, and I think some of them do, you know, at times, let's say you have an institution who's playing around hedging, 1,000 or more BTC. Well, now that's going to totally dominate the platform.
Yeah.
And, and I don't think Ledger X is necessarily at that point of that liquidity, but CME, they understand that. They understand what needs to be what needs to be done there from a risk management perspective. Obviously, there's regulatory hurdles to claw through when you're issuing, a second derivative on a digital currency.
Yeah.
So
that's definitely not a smooth road.
But I think they should. I think they're going to do it sooner rather than later. And if they don't, well, then they should, because at this point for them, it's as easy as flicking the on switch, and that would really, I think, really bring crypto options to life.
Yeah, let's hope. That would be cool. That would be a game changer.
That's at the point where you're going through KYC and opening up an account and
exactly
trading this stuff against, especially let's say if you're a big crypto fund or a miner or one of the hodlers, somebody with a ton of exposure who wants to use options to trade or speculate or hedge your position. This is options are an excellent tool to do this, and it's something that the crypto market is quite frankly lacking very sorely.
That's what I'm most excited, and people are always like, oh, what are you most excited about with crypto? And it's like, well, I'm not a dev, I'm a trader. So what excites me the most is seeing the option space develop more. Because it's really cool. And seeing what Deribit's done so far, it's really impressive what they've been able to build. With, granted it's a smaller market. But yeah, we got so much room just to go up, right?
Yeah, and also too, it's important to note that I like who's behind Deribit. Like these guys are, you have one guy who's a former options trader, and that's the kind of, and as an options trader myself, that's the kind of guy you want leading this charge. Somebody who knows exactly what a user on the platform wants out of the platform, and it's got a lot of space to grow. I just don't know if they can do it as it sits now.
Interesting. Okay, so let's now get into options and kind of like strategies around them. But let's just break down a bit of the basics for people first, who maybe have never really even looked at options before. So let's just start with the Greeks, because understanding the Greeks is pretty important, and if you don't understand the Greeks, you're going to be in for a tough time. So let's give a quick rundown of the Greeks.
Okay. So the first thing, in terms of Greeks, this isn't something you're going to grasp overnight, and me talking to you about this, it's going to sound like Chinese, but the options Greeks, what the first thing you look at an option is its delta, I suppose, depending on what you're trying to do with the option. But the first thing a retail trader is usually going to look at is the delta. Delta is also considered the hedge ratio. So let's say you own an at-the-money option. At-the-money options usually have a 50 delta.
Right.
Okay. I'll explain the intricacies on this when we talk about Deribit and the actual deltas on different options. But so figure about this. Let's say you own an at-the-money call option. I mean, if you aren't familiar with call and put, a call is a buy option and a put is a sell option. If you own an at-the-money call, okay, then let's say Bitcoin moves up $100, then the value of your call will move up $50 because that's a 50 delta. It's going to move up 50%. Okay, and vice versa. Let's say you own an at-the-money put with a negative 50 delta. If the price of Bitcoin goes up $100, your put is going to go down $50. Okay, and then if you move into kind of the gamma, that's the rate of change of the delta. Okay, so let's say you own the same at-the-money option, 50 delta option that has a 10 gamma. So now, if BTC goes up $100, your at-the-money option goes from having 50 delta to a 60 delta. It's going to have, and think of that as having a bigger sensitivity. It's going to have a bigger sensitivity to price moves as it becomes closer to or more in the money. I mean, that's the best way I can kind of describe that to a newbie trader. Now, the Vega, this is the good stuff. This is what the option market makers look at. The Vega measures the implied volatility of the option.
Okay.
So let's say again, you're looking at the money Bitcoin option. And by me saying at the money, I'll say like the 9,500 call, and we'll say Bitcoin's trading $9,500.
Okay.
Intrinsically, what's that worth?
95.
Zero.
Yeah.
No, it's worth zero. It
Yeah.
has no intrinsic value because if it expired, it would,
okay.
it would have no moneyness to it. So every dime in that value is implied value. And that's, that's just the implied, that's just what the market thinks, how much the market thinks Bitcoin is going to move on an annualized basis. Okay. So I don't know if you guys want to pull up the Deribit stuff here now. So for say the Augie, you can whenever you feel like it. The August 10,000 call right now, is trading, when you're looking at the IV over here, the implied volatility of the market, it's 99.5% bid at 103% bid. So it's 170. That volatility spread is what the maker makes every time you trade on the bid or the offer. That's essentially what he's trading because he's hedging his book accordingly. Right. But so think about it this way. So as implied volatility, let's say if applied volatility goes from 100 to 150, the Vega is the change of your option value based on implied volatility move. And bear in mind, the product doesn't have to move for Vega for implied volatility to change. All that could happen is somebody just starts, say, buying options, and this will happen. Somebody just starts buying options. Well, the product is not moving. Well, they're still buying. They're lifting every single offer in the book.
Right.
Okay. That is implied volatility going out. So let's say if an option has a Vega of 1,000, then with every 1% move up in the implied volatility, the price of the option will move up or down $1,000.
Okay.
Now, $1,000, that's not really appropriate, but that's the way you look at it because say, if let's say you own a whole bunch of options, and net your options portfolio has a Vega of 100,000. Well, as Vega for the whole portfolio goes up or down 1%, the value of your portfolio is going to go up or down $100,000, and that's like a Vega exposure. It's interesting to kind of note that because, say, in a product like gold options, which I traded for many, many years. I still do trade gold options, just not as frequently as the crypto stuff. But gold options, you can have a much bigger Vega profile. Let's say you can be like being long a million Vega in gold isn't as big a deal as necessarily even being long 100,000 or even 50,000 BTC Vega, because Bitcoin, I think the vol moves a lot more frequently in there, and also has a lot more upside susceptibility. There's only so high gold options vol is going to go.
Real quick, Alex, I want to just interject. Yeah. If you're listening and we've got the Deribit options pulled up on the screen, so if you're listening, you'll be able to pull up the YouTube and kind of follow along with what he's saying. So.
So then the other thing I mentioned, that's cool. That's good that we're talking about that. The other thing that I wanted to mention that we talked about earlier was the Theta, and that's the change in value as time goes along. So an option with every independent option is always going to have a negative Theta. So if you own it, if you're long the option loses value every day, and if you're short the option, well, then you gain value every day. It's the opposite. So it's important.
Theta is my favorite. Yeah.
And Theta is important to watch, especially for the beginner traders, because as you approach expiration, Theta goes up. The options decay faster and faster and faster right before they expire. So an option with a year left is going to have a lot less Theta than an option with a day left. So especially if you're trading the near month options, watch that Theta and it's very important to internalize how quickly that option loses value, whether you are short or long that option.
That was one of my biggest wake up calls when I was first kind of diving into options was, how you could have a position where, you buy a bunch of calls, let's say, and, price is still higher than it was when, you had initially bought these, the spot price, but yet your options, you can actually be losing money because the theta has just, just theta burn, and you've just been shedding value. And that was a huge wake-up call for me. It was like, okay, this is a whole different game.
Yeah, and that's also too that there's going to be less Vega in an option that's closer to expiration and more theta, because a lot of as you get closer to expiration, the implied value goes out. Now, once the option expires, vol goes to 0.
Right.
So, that's something that a short options trader will always remember. Will always, a short gamma guy will always let you know that.
Okay, so now let's touch, and before, because I want to get into some strategies, so just some basic breakdowns of, different market situations and how we might approach it to build a trade. But just before we jump into these different scenarios, the last thing I want to cover is just a rundown on selling options. Because this is kind of like, this is the space, the side of it where, you hear a lot of people, it'll either be like, oh, that's scary, you can really get, really wrecked doing that, or this is the holy grail, like this is how you need to be trading options and focusing on selling, if anything. So I'm curious, just kind of get a rundown from you now on this.
That it's a lot of that is, I think, an opinion and also on the style of trader. A lot of traders love to own options. A lot of traders love to be, they love to be long gamma, and they love to own the gamma. They love to be sensitive to the moves, and they love to own Vega. And a lot of traders like to be short gamma, and a lot of traders like to be short Vega. And a lot of traders like to be, collecting and not decaying in their position. A lot of that is an opinion thing. I mean, I'm speaking about it mostly from a market maker perspective. From the beginner's perspective, from somebody who's never traded options before, the bigger short gamma or Vega positions you have, the more sensitivity you're going to have to something that you really probably don't understand. So I would try to avoid those positions. Now, when it comes to selling options, I think some of the best strategy is, though, for a beginner is to sell options, is to sell puts. I think I spoke to you about that, Fritz, where I was just saying, hey, one of the easiest things you can do, especially if you're a long-term bull on Bitcoin, is just to say, hey, I'm going to sell, say, the 6,000 put, and if it never goes there, I pick up the premium. And worst case scenario is I bought Bitcoin from $6,000 less the price of whatever premium I collected. So also, too, when you're talking about defining your risk management, selling puts is a very easy way to do that.
That was by far, like, in that whole back in May when, the markets were, again, they were just going crazy, right? Like we had pumped off the bottom and it went up like over 3x in just a matter of months. And I think that was really selling puts was the main moneymaker. And I loved it because, you're making, at the time I was selling puts on Ethereum, and, you're bringing in Ethereum value. The value of Ethereum keeps going up. It's I loved it, but again, it's a situational thing, and
it's also too important to recognize that when you have that big pump up, and you not only have you have a pump in the implied volatility. So the price of not just say the call options, but the at the money options and the put options, the price of every option goes up because everybody has expected more of a move out of the market is expecting more of a move out of the product. And when the implied volatility gets high, this is when the short premium sellers love to come in and whack it.
And it was insane. It was like, it got, like, I think right now, IV, what's it reading on here for these?
Like 100.
Yeah, around 100. And like back then, it was getting up to like 130, 140. And it was just like, I'm looking at this, I'm like, holy shit. Like,
when Deribit options were first listed, and when I was first looking at them in 2017, the vols were in like the 200s. It was like a 200 or 300 vol product. And that was the really good time for premium sellers if you had the right risk management perspectives in place.
See, and that's kind of like when I look at the Deribit, the option book and everything, when I'm looking at it, usually I'm looking at it in the mindset of, what puts could I sell? Because I find the premium, the IVs, the IV is so fat that I'm not the biggest fan of being a buyer, right? I would rather be a seller.
Well, yeah, it's kind of cheap. Like, and there's a way to calculate this. I'll get into the break even on options. You know, kind of later on. I love the fact that crypto markets are open 24/7, 365, that you don't have weekend gap risk that is, you know, endemic of the traditional markets. I thought there was
CME boys.
I know if you wanted to talk, well, I actually had it better because we only had an hour break every day. And whereas the equity markets, you know, would get very, very thin in the off hours. Now there's something I wanted to talk to you guys about is skew. I don't know.
Let's touch on that. That's a term that's been getting thrown around more, but I don't know if people are familiar with it.
Okay, so this is something that Anthony Pompliano, I think that's how you say his name. That Pomp was talking about, and I tried to dig up the tweets before this, but I couldn't find it. He was saying, he was like, you know, equity options have a put skew, and Bitcoin options have a call skew, and this, you know, signifies fear in the markets, and everybody, you know, fear dominates the equity markets, and greed dominates the Bitcoin markets. Look, I like Pomp. I think he's a really smart guy. He's extremely bullish, but he's really, you know, really, really smart dude. But that was not a fair characterization of Bitcoin options and of skew. Equity options trade with a put skew, and they've always traded with a put skew after the 1987 crash. Because, you know, anybody who owns equities wants to be able to protect themselves. But like Bitcoin options, the skew is there's a slight call skew, but it's not that aggressive. Like say the at the money strike in even the DECE options, where you would see the skew be a little bit more pronounced. The vols are only say like creep like 5-10% higher. You know, at the money strikes in 96 and 106. Whereas if you take a look at, say, a gold option for the same expiration, now gold vol is trading much cheaper. It's trading like 10%. But you know, you take a look up at this. You take a look up through the strikes on gold, and the, you know, say the 1600 call in December is trading with a 15. You know, a skew of say 15. An option volatility in the 15s. I'd have to see where I scroll up. Yeah, even before the 1600 strike. So, you know, it's not like when you're talking about something that has 50%, an option that has 50% more skew in it than the other ones. Now, I guess gold's not really a fair characterization, but that wasn't really a fair statement by Pomp to say that Bitcoin has a call skew. The skew is relatively flat. And the reason for that is that the option premiums are so high that you're talking about a 100 vol product that moves on 100 vol. When a product moves from $4,000 to $13,000 in a quarter, well, that just moved on a you know 200+% vol in a quarter. So, you know, that's what blew out a lot of the market makers, especially the guys who were short premium sellers. And
you know, I remember, like, especially, it's just, I still remember this, seeing an article right around when the market was bottoming about how big mining operations were finding new profitability in the markets by selling calls. And then sure enough, that was the bottom of the market. And I just, it just makes me cringe, you know. It's like,
it's actually smart for them to do that. If you think about it, because you're sitting, especially if you're a guy who's like somebody who's running a mining operation who's sitting on this huge stack of Bitcoin, and you're like, say, oh, I'll sell as many 7,000 calls as I feel like, because if it goes there, great, I'm still alive.
Okay.
And I'll sell the product for 7,000. It's like, that's a covered call. That's not a naked call. So like,
so let's get into the difference there on the difference of a covered call and a naked call.
Okay, it's as simple as either you have the underlying to protect it or you don't. So let's say you sell the DECE 20,000 call. Then let's say you sell one of those, then you would own one Bitcoin against it. So you're basically from the options trader's perspective is you're saying, I'll sell Bitcoin if it goes to 20,000. I'll sell the one Bitcoin I own, and if it doesn't go there, I'll collect the premium. And that's I think is again a defined risk management strategy. That's good for a long trader. I don't even necessarily really like doing that though, because once Bitcoin goes to 20,000, you don't know if it's going to go through and go to 200,000. You've really capped your upside there significantly, unless you're like the miners, they've got to survive. They've got to do everything they can to pull in capital. A hodler is probably saying, a guy who's owned Bitcoin since it was $20 is probably saying, like, I said I'd sell when it gets to 20,000, and I will.
Yeah.
So
Okay.
it's not a bad strategy. I don't like selling covered puts against your short. I think is not very smart in this market.
Okay. Interesting. Okay,
That
let's get going into some scenarios here.
Mhm.
Dale, you get the scenarios going because I've been hogging all the questions here.
Well, like I told you in the DM, I was just like, man, I'm learning. I'm not a huge options guy, so I'm sitting over here jotting notes, and Princess is right up your alley. So, Alice, let's start with, let's say you're bullish Bitcoin and you want to capitalize on potential upside.
Okay, so I can just say it's easy for me to say I'll buy calls and buy which call, whichever calls you want to it. You know, the listeners already know that. But something else that you can do is you can do what's called a call spread. So say you're buying one call and you're selling the other. So let's say for example, we've got the D strikes up here. I don't know if you guys want to move down to the upside here a little bit so you can kind of take a better look at what we're doing.
Here, 1 second.
So let's say a good scenario here is, say you can buy the 10,000 call and sell the 15,000 call against it. So you're buying that call spread for, say, roughly, let's say $1,300. Now the max profit you can have on that is, you have the 5,000, that it can go in the money less whatever premium you pay for it. So your max profit on that is, so you're risking 1,300 to make 3,700. I'm not going to get into the intricacies around expiration, but if it's sitting around your short strike when the options expire, be careful, or your long strike for that matter.
And what did you call this strategy?
This is just buying a call spread. Okay. So now here's something else you can do. Let's say you don't really like the idea of that. You can do what's called a ratio call spread. All right. And let's say you buy one of the, I'm going to get a little bit more bullish on this because this is a way I would actually structure one if I was trading this. I would say buy the 15,000 call and sell 2 of the 20,000 calls. Okay. So say you're doing that for close to flat premium. All right. That's it. You're in effect actually selling a little bit of that upside skew there. That's not really skewing the options because you have one vol that's trading it at 90, 97 and one vol that's trading at 100, 101, wherever it's trading. And that is closer to flat premium. And also too, you have to remember that as time goes on, that you're actually collecting theta on that. Yeah. Because those 2,000 calls, that short call is going to decay a little bit faster. Now, the key thing to remember is, so you're looking for that thing to go to 2,000, because after it goes through 2,000, you make up to 2,000, then you start lose. Yeah. And then when you get past 25,000, you're down money on the trade. So if this thing explodes, you got to be really, really careful with that. And I think that's what a lot of guys, again, that's what the guys blew out doing, selling, being short skew on ratios, selling calls. I don't think it was necessarily miners. It might have been them. But again, the miner just sends after that, he just sends his Bitcoin to the exchange and he doesn't care. The maker might not have Bitcoin to send to the exchange, and he might have Deribit take over his position. So, that's another strategy you can do. Also, too, you can do that in a different ratio. It doesn't have to be 2. Say you can do it in 1 by 1.5, or 1 by 3. You're getting a little bit more, more or less aggressive depending on how you try to ratio that. And the idea is collect more, you would pay or take in more or less premium depending on your risk tolerance. Another thing you can do is what's called a butterfly. I don't know if you guys are familiar with this one.
No, let's
no.
break down.
So that's in effect a way to stop out your cap your loss. so to
Okay.
speak, on the upside. So you can't lose money. So let's say you buy one, it's in effect, you're buying one call spread and you're selling another call spread on the same strikes. Now, if these strikes are equal, unless something has absolutely gone completely haywire in the market, which I don't know if I don't know if it's really possible, but I guess it could be, where the 2 is premium, then let's say you do the 15,000, 20,000, 25,000 call spread. There are 25,000 calls not listed here, but it doesn't matter. I mean, just for the sake purposes of example. Then you would be buying 1, selling 2, buying 1, and you're always going to lay out premium to do that.
Yeah.
But what you are doing by laying out the premium of buying that 25,000 call on the back end is you're stopping it out so you can't lose money.
Okay.
You can structure the trade in any sort of different manner, say selling 1 by 3 by 1, or doing other things to kind of change up your risk profile, 1 by 1.5 by 0.5. So there are other ways you can kind of position this however you want to, and you can look at your options, Greeks, and risk management to figure out where you want to put that.
Okay.
That's just like, these are just like a couple upside scenarios that you could do outside of just buying calls. I think the idea of doing call spread 1 by 2s or butterflies is really, really good for the people listening to this.
Okay. Interesting.
Especially the butterflies, I think, because that gives the listener an opportunity to take advantage of an upside move and kind of pick a target. And by picking that target, you can also sell some of that really, really expensive skew if they really blow out.
Okay. Okay. Next scenario now. Let's do. Okay, we don't really have a clue what Bitcoin is going to do, but we feel pretty confident that volatility isn't going to die down. How might we try to capitalize on that situation?
Okay, so you could just buy straddles.
Yeah.
Or you could, in theory. I don't like the idea of buying strangles necessarily. So a straddle is the real, think of that as the arbiter and the guideline that everybody uses. So let's say if I ask for a straddle run in the morning, then like if you ask for a straddle run from a broker will quote you the straddle on every single at the money strike. And that way you can get an idea of what at the money vol is very quickly and very easily.
Okay.
So a good way to kind of gauge this to you when you take a look at the straddle prices, if you buy the call and the put on the at the money strike, then that theta is going to imply a certain break even. So that's the amount that the option needs to move for you to make money on that and not lose money on the theta bill.
Right.
So let's say the break even on a Bitcoin option today is $250. Okay, well, Bitcoin needs to move $250. And now if it moves more, great. And this is also the good thing about trading, from the long gamma side, is let's say it does move $250, then you can hedge it. You can hedge it according to that delta that you have. Okay, so now it moves $250 and it goes down $250 and you're short 10 deltas. You buy those 10 deltas. Okay. Now it goes back up because, like you said, you predicted the market to be very, very volatile. Now you can sell those back out. That's how you cover and capitalize and make money in times of high volatility if you think volatility is going to stay prolonged high. But again, there's somebody on the other side who thinks something totally different from you.
Right.
So volatility is usually cheap or expensive for a reason.
All right, third scenario, Dale. Let's pump it off.
Next one. Let's do this. The market volatility has died. What's the best way to take advantage of it?
Well, you can sell the straddles, but that's obviously, a lot of people do that, but that's a very, very dangerous to just start naked selling straddles, because now you've basically given yourself an unlimited risk portfolio.
Yeah. That sounds pretty terrifying.
No, thank you.
So what you can do is, if you're getting a little bit on the aggressive side, if you're really aggressive, then you can sell the straddle. Then you can sell the straddle and buy a strangle. So I didn't go over what a strangle was with you guys. A strangle is two out of the money, usually out of the money options. Sometimes they can be in the money, whatever. So let's say a strangle, excuse me, right now would be the 5,000, 15,000 call, put 5,000, put 15,000 call strangle. Okay. We'll go over, selling those in a bit, but what you can do is what's called an iron butterfly, where you're basically selling an in the money butterfly. You're selling the straddle and you're buying a strangle. And you sell the straddle because that straddle's obviously got all the premium. And if you think, you're saying the market volatility has died, well, then that's a great way to take advantage of it, is to stop yourself out on the risk by selling that. You can also sell what's called an iron condor.
Okay.
This is actually an excellent strategy that I've done a lot. You're selling a call spread and selling a put spread.
Interesting.
So let's say you think the market's not going anywhere, then you could say sell the 8,000, 7,000 put spread and sell the 12,000, 13,000 call spread. All right. Let's say you collect, $300 worth of premium on that. All right.
Mm-hmm.
Now you're only going to lose on one leg, and the most you can lose is $1,000. All right.
Okay.
All you've got to do is manage, essentially all you've got to do is manage one side of the trade. But if the market volatility goes crazy, then you might have to manage both sides of the trade if it gets really, really ugly. But it is important to, understand that it's like you're giving somebody, say, 3-to-1 odds if you do that, roughly 3-to-1, or 3-to-7 if you want to be precise. Selling a $1,000 wide one for $300.
Okay.
That's one thing you can do. Another thing you can do is just sell strangles. But that again, that's an extremely risky scenario where you're selling the 5,000 put and the 15,000 call. A lot of pro traders sell strangles, and that works until it doesn't.
Especially in crypto, it's like
I would not sell strangles in crypto. But you can, you can if you think the implied volatility is so stupidly high that the only place it can go is lower. Then yes, you can do this, but the important thing is that you have to manage a short gamma position. So if this starts to move against you, and I won't get into short gamma scalping, but every short gamma scalp is a permanent loss of money. And the vol might go, your volatility position might come back, but a short gamma scalp is realized loss. So I'm not necessarily, I have been short gamma at times. I don't necessarily like it. It depends on on what the market conditions are like. But if vol goes back out to 300%, you got to start looking at selling it.
All right, Alex, last scenario. You're bearish Bitcoin and you want to capitalize on the downside.
It's kind of the opposite of what we said earlier. With the call spreads, you do the put spreads, and this is somewhere where you can actually get. I think when you're bearish, you can get more aggressive on the downside with selling options. So, say, I talked to Prince about this. Let's say the put skew, and this, to Pomp's point, this is going to happen at some point. There's going to be a very, very aggressive put skew at some point in, whether it's the near or far future for Bitcoin. And that's going to be something that you want to look at selling when those puts are so stupidly expensive that, there's nothing you can do but sell. So let's say Bitcoin goes down from 10,000 to 8,000 in the snap of a finger. There's bad news or something. You think it's going to follow through, but also let's say you have a target of, say, 5,000. Now, you remember those put spreads that those call spreads we were talking about? Do the same thing for a put spread where you're buying one put and selling another. But remember when we were talking about, ratios, this is I think the best time for a crypto trader, especially somebody who's bullish on the space, to sell options, is to, in a bearish scenario where the put skews have blown out, where you're doing ratios, you're doing 1/2 or 1/3. And it gets to the point where you're not necessarily as concerned about losing money because the lowest Bitcoin can go is 0. And all you have to do is margin your position. Let's say you do a 7,000, 5,000, or 6,000 1x2. All right, where you're buying one of those 7,000 puts and selling 2 of the 6,000 puts. Well, what's going to happen there is that you're not going to lose money until 5,000. And, that depends on whether or not you laid out premium or collected premium to do this. But that's, I think, an excellent trade, especially if you're bearish. But obviously, if you're totally bearish. But that's one thing you can do. Getting into the ratios and the butterflies. I mean, you can do a condor as opposed to a butterfly. A condor is just moving the strikes around. So say you remember when I said a butterfly is buying one call spread and selling one of the same strike?
Yeah.
A condor is just buying one spread and selling another call spread of a different strike.
Okay.
So it's just terminology. They call it butterfly because that's how your risk reward payout looks, and same thing with a condor, bigger winged bird. So I absolutely would get aggressive selling puts if you're ultimately bearish on Bitcoin, especially if you have the capital to buy it at, say, 5,000. Getting aggressive selling the 5,000 put, especially on a ratioed basis, to stop yourself out, where you're buying the 6,000 in front of it, and you're not going to lose money until it goes to 4,000. That's a great, excellent trade, and I highly recommend people start to look into that one.
Interesting.
All in options. Let's go.
Okay, so one last question for you, Alex, to wrap up here. Now, we were chatting one time, and you got some crazy stories from the floor, right? On just like some shit that you've seen go down for guys who, be managing huge positions. Everything looks to be going right. And you kind of told me one story, and hopefully you don't mind telling it again here, just because I think this one story goes to show just how much, your Greeks and all that, and just little things can really affect everything about your options positions. You had that one story. You remember the one you told me?
I know what you're talking about because I just told it to somebody else. I told this to a professional risk manager at JP Morgan the other day.
Yeah, this is a good story. I'd love it if you could just tell it again here.
The one thing I didn't mention in all of this is Rho, and because Rho is interest rate risk. That's the one Greek I didn't mention, and it's not pertinent to this discussion that we're having.
Right.
Where it is really pertinent is in the later years. Now, the way crypto options work is, I don't know. I'm not particular on the details on funding, but one person pays the other. But you can kind of see if you take a look at put call parity, that put call parity doesn't really exist as much in the crypto markets. The conversions will go off because that's the way, the cost of lending and borrowing on short and long positions works.
Right.
So, like, in terms, why is lending and borrowing important? It's not really that important if you're only lending and borrowing for, say, 3 months or 4 months or 5 months or 6 months. There's only so much you're going to lose on the rates unless the rates get absolutely crazy big.
Right.
Now, in, say, 2007, we had U.S. interest rates here at, what was it, like 3.5, whatever %. And one of the old games that the guys on the floor used to play, and I used to play this too as well, was doing deep in the money call spreads, where they would sell a call spread that's in the money, and they would try to exercise one leg to capture open interest, where they're essentially being short and get an option that's totally worthless, and getting a big fat interest check from the clearinghouse to lend for that. Okay. That's great. And that's all fine and games when you're doing it with 1 month. But one of the things you're doing is, and I've traded options portfolios 3 years out.
Yeah.
Okay. And when you're trading 3 years out, you have to understand that those options have a lot more sensitivity to interest rates, because I don't know how familiar you guys are with an interest rate term structure, but that applies to the cost of lending and borrowing options in terms of the Black-Scholes options calculation formula. One of the key parts of the Black-Scholes formula is the risk-free rate of borrowing. Okay, and that's something that you have to put into all your models. Now, most options models don't look at that. The only way to measure rho is to manually move your rates. Anyway, these nat gas traders, these guys were always short, long dated calls because they were collecting in these big fat interest checks from the clearinghouse every single month after month. They were lending money to the clearinghouse by being short these deep in the money calls. And that was all fun and games until 2008 came around and rates started to go down. Okay. So what happens when rates go down? Well, your cost of borrowing goes down too. Your model factors the cost of carry into that option. All right. So as that cost of borrow goes down, those short options that these guys were short just started going up and up and up because they didn't even look at the rho in their options at all. Now, again, when your rho is not really going to matter when you're only trading a portfolio six months out. But when you go out to say 3 years, 4 years, 5 years, 6 years, and you don't watch your rho, especially if you're, creating a big lending borrowing position, which you can put on for yourself and not realize, depending on what your capital requirements are or aren't. If you're at a big bank.
Yeah.
And this guy blew out on interest rates that were not, and lost, say, something in the neighborhood of $150 million and almost took down an entire clearinghouse.
Fuck.
Wow.
On interest rates.
That's crazy.
So and this is a guy who knew it all too. But obviously you never know it all. And there's a lot of stories like that. So there's another story from Sugar where this guy was just, you remember I was talking to you about selling straddles?
Yeah.
It was a sugar producer. You can read up on this. This guy, it was Fluxo. All right. This was right before I started trading. This guy every single day would come in and sell the straddle. And he would, this is a massive, massive sugar producer out of Brazil, would control both sides of the market so that anybody who was long all that gamma, it doesn't matter. They were helping him do that because they were, doing their long gamma scalps both way. And this guy was in effect trading his negative gamma like it was positive gamma. He was doing this through 3 or 4 or 5 different clearinghouses. And it got so bad, the exchange turned a blind eye to this because he was, a massive fee generator, but he effectively killed the sugar market. It got it wasn't moving. So it got so bad where all the clearinghouses got together and went to the exchange and said, we are really worried about this guy. If sugar moves in one, his risk portfolio is obnoxious. All he is short options if it moves. And eventually the exchange had no choice but to listen to him and listen to the clearinghouses, and they forced him to cover. And all the brokers who in effect hated this guy because all the other brokers besides the one that he was dealing with hated this guy, and they blew him out. They single-handedly they went out of their way to inflict as much pain on him as possible. I heard stories where guys were saying, they're yelling, they're like, at 18, at 19, I'll sell him. And the broker just turns to him and says, buy him at 22. Right through his offer, because they're trying to inflict as much possible pain on the guy who effectively killed the market. And that's
that's crazy.
That's insane.
That's insane.
And you hear a lot of, there's a lot of, everybody's got a story about some sort of argument, some broker butchering an order and cutting somebody out. But, when that was something that was really eye-opening, just seeing, and hearing the stories about the brokers just going out of their way to hurt this guy because he wasn't even their customer.
Damn.
That's crazy.
That is crazy. All right, Alex, if anyone has some questions for you, or I shouldn't say questions, but if anyone wants to kind of follow anything you're putting out, or wants to seek you out for employment, like you had mentioned earlier, where can they get a hold of you at?
I don't want to just throw my email address out there, but I have a LinkedIn profile. Connect with me. Say you're on the Crypto Street podcast.
Do you have a Twitter or anything? Is what I was kind of getting at.
I don't, and I probably should start using it.
I tell you what, just send the podcast account a message if you're interested, and we'll relay the message.
Yeah.
Sounds good. I don't know.
I wasn't setting you up for an email. I thought you had a Twitter.
Yeah, I mean, maybe I should be better. I'm not very good at self-promoting, so
That's all right.
and putting out calls. I can. I'm not you guys.
No, I feel you there.
Trust me, I don't put calls out either.
It's overrated.
Yeah, it totally is. So I think after this, everyone that listened is probably, well, not probably, should have a better grasp of options. So Alex, that was fantastic.
I'm happy to help you guys. I know that it sounds a lot like Chinese, but really, if you are sitting on an options portfolio and you have questions about it, feel free to reach out. And if you are trying to structure anything in any crypto world, I'm talking to a lot of people about a lot of projects, especially if you got an options one, because that's where my background is. But also too, anything. I've been in talks with a lot of people about a lot of different projects. I'm working with. I've been really trying to actively fundraise for Trive. It's kind of having some problems. Been in a nascent stage where it's a media news verification platform. It's just had a lot of problems getting off the ground in terms of seed round funding. But yeah, I'm obviously very bullish on the crypto space long term, like you guys are. Question for you guys, traders.
Sure.
I know you don't like making calls. Short term, where do you guys think we're going for the next month, too?
So I'm kind of just waiting for the September quarterlies to come to an end, and then I'm probably going to be getting pretty bullish. And like I kind of got my game plan already. I have an idea what I want to do, but I'm waiting for September, end of September. I kind of operate around the quarterly future contracts with a lot of what I do. So I'll just kind of operate around those expiries. And so I'm kind of waiting for this one to expire, these Septembers to expire. And then I plan on getting really bullish. So
are you talking about the MEX ones?
Well,
or the CME ones?
MEX, I'm not using CME. No.
Okay.
I'd be too scared to use the CME with them closing over the weekends.
Yeah.
Well, can't you hedge it with MEX?
I guess you could, right? Like, you definitely could. I don't know. I've never really even thought about using them. I'm using I haven't used MEX in a while. I was using Deribit for a bit, and I've been checking out FTT or FTX, which is pretty interesting. But yeah, there's so many derivatives platforms out there now in crypto that
the problem is I think again the regulation. I'm not going to get into a politics discussion on regulations, but unfortunately it really limits a lot that American customers can use. I mean, especially if you want to be above board. And the CME is unfortunately one of the only good options, because I would really love to be trading more actively on Deribit.
Yeah. All right, Alex, man, thank you so much. This was great.
You guys.
Every time I chat with you, I learn a shit ton. So it's awesome. Thank you.
Appreciate you coming on, Alex. For Prince, myself, and Killer Whale, even though he's not here. Thanks for listening, Alex. Take care. Tip your waitress.
Take care, guys.
We'll check you guys later.
See you later.